All right, so for the people that are here, my name is Renee Targus. I'm the editor of Agribusiness Global, and I am your MC for today. Just a few housekeeping things before we start with our opening speaker, Derek Oliphant from AgbioInvestor. I want to thank our sponsors, Rainbow, TrustChem, Alba, Maxinotech, Langcheng Biotech, Tagros, AgroCity, Fuha, Drexel, GSP, Alba, Megamani Organics, and Inventus. And then our partners are CPDA and AgroLatam. We want to thank our advisory board for helping us put together this show. And then also, if you're interested in any of the PowerPoints you see today, you'll be receiving an email, and then you can download them after you take a survey. We're on social media right now, so if you want to hashtag Trade Summit or ABG Trade Summit, you have a chance to win one free registration for 2025. Whoever has the most posts will win. And then please join us tonight for our cocktail reception. And we're having another event in Southeast Asia, in Jakarta, Indonesia, in November. So we hope to see you there if that's a region that you're interested in doing business in. Again, Agribusiness Global is a community. We've got e-newsletters, video, podcasts, articles. So whatever conversations you start here, a lot of the speakers that we have will be contributing to us throughout the year, and you're able to see them in live webinars and engage with them on LinkedIn. And then again, we have our Agribusiness Global Direct. You'll all be subscribed to that as attendees of this event. So you can see that. If you don't already get that, you'll be getting that in your email. All right, so I would like to introduce our opening speaker, Derek Oliphant. He's a partner of AgbioInvestor, and also he is a contributor to our Agribusiness Global Direct. Every month he provides a column, and I'm going to hand it over to him.
Thanks, Renee, and thanks to Agribusiness Global for inviting me along to speak here today. I represent AgbioInvestor. We are a global crop protection market analysis and consultancy company. So today I'm going to speak about what the crop protection market is looking like moving forward, where it stands now, and the key drivers for the future and what the future growth prospects look like based on a number of different factors across the industry. So we'll start by looking at recent trends. Now you can see this slide is going back quite a few years. We want to go back to essentially a transformative stage in the industry at around about 2000. And this is when the uptake of GM seed started to really take value out of the crop protection market. So we had, for example, herbicide tolerance traits, insect resistance traits as well, but mainly herbicide tolerance traits at this time that would take value out of the crop protection market through use of non-selective herbicides such as glyphosate and others where herbicide tolerance could be applied through traits. But since that point, the market started to increase again. We've accepted the fact that GM traits are going to be a value reducer overall. But we are seeing issues such as resistance development to the broad spectrum products such as glyphosate, requiring usage of much more tailored weed control programs, which obviously benefits, for example, selective herbicides. But if you look in the last couple of years, this is going up to 2023. 2024, we don't have the full data set, but we do expect it to actually be quite a negative year in terms of market performance. But if you look at 2023 and 2022, recent years, we can see 2022 a significant increase in the value of the market, driven by very high levels of agrochemical pricing, very strong commodity prices as well, and also favourable weather in a lot of key markets. However, since that point in 2022, which we would be considered a sort of recent peak in the industry, there's actually been a lot of difficulties for companies that are active in this market. We've seen agrochemical prices start to come down based on a normalisation of the supply situation coming from China in particular. We're seeing commodity prices start to come down. Commodity prices are a significant influencing factor in the crop protection market. We'll see that in some slides later, but the value of commodity pricing has a huge impact on the value of the overall market. However, some of the offsetting factors here is recovery in Northern Europe, so better weather in a lot of the key European countries in 2023, And the pricing situation for European material hasn't been as negative as it has overall based on output from China and to a lesser extent India as well. But as I said, 2024 is looking to be significantly more negative than that, and we're looking at sort of mid to high single-digit declines in 2024 based on early estimations. Now what we've done here is break out the recent years into the effects of volume, price and currency in the market. Obviously we're reporting the value of the market in US dollars. So when you look at local currency exchange rates, this is going to have an influencing factor on the market when we translate it into that currency. So currency has a big impact to play. We also look at agrochemical pricing as well, and also volume, so the volume of crop protection products that's being applied. Obviously this is very significant in how the market can develop, and a lot of the volume is based on, in recent years, fluctuations in weather conditions, for example. But we've seen a general trend towards lower volumes based on new product introductions that are active at lower rates, and we've seen volume reduction programs being implemented in countries such as China and in the EU as well. So volumes in general coming down, but it is variable depending on weather in a lot of cases. If we look at the last couple of years where we have the full data set, what we're looking at in 2022 is the big inflationary effect of agrochemical pricing, but also volumes up as well based on improved weather in a lot of markets, particularly in Asia. But currency a bit of a negative. The US dollar remaining quite strong against a lot of these other currencies such as the euro, the Indian rupee, Chinese RMB, etc. And if we look at 2023, again volume demand is relatively well sustained based on improved weather in Europe in particular. However, we're seeing pricing impacts start to come in here where it's negative, and also currency is continuing to be a negative as the US dollar is quite strong against most other major foreign currencies. For 2024, we expect the price decline to be even more radical. Volume is also difficult in 2024. We've had poor weather in Europe, a lot of Asian countries as well suffering from a lot of weather-related issues, particularly India. So 2024 not as positive, and in fact, as I mentioned, it will probably be a decline in overall value terms. Now I mentioned how commodity prices can have a strong influencing effect on the value of the crop protection market. Now obviously the more money a farmer gets for the commodities that he grows and then sells, then the more he has to spend on crop inputs such as crop protection products. And you can see in this chart the blue bars actually show the value change in the market year on year. So obviously where the higher bar is, then the better the market is, the more buoyant the market. But the lines are reflecting the prices for the key traded commodities globally in maize, soybean and wheat. And you can see there's a very strong correlation between when prices of these commodities come down and how the actual market performance is affected by that. So for example, 2022 we've already seen commodity prices, they spiked at very high levels and remained high by historical standards, and we had a very positive market in 2022. 2023, commodity prices coming down significantly from those peaks, and correspondingly the value of the market is being affected as well. But if we trace this back historically, you can see that there's the similar trend in all the years when commodity prices rise and fall. For example, 2006, low prices actually decline in value in the market. 2008, high commodity prices, a lot of this stemming from the financial crisis when a lot of investment was put in towards soft commodities rather than other commodities such as oil, for example. And you can see that these strong correlation between commodity pricing and the value of the market. And as you can see here in 2023, as the commodity prices came down, this is one of the factors behind market devolution. And if we look at 2024, we're still looking at a situation of very low commodity prices. So that's another reason why we're expecting the market in 2024 to be quite negative overall in terms of performance. The growers are getting much less for their crop now. They're really struggling with high costs. Although agrochemical pricing has came down, we haven't seen the same rapid declines in other costs such as fuel and energy, and also seed as well. So farmers still have a lot of high expenditure that they have to put into their farm, but correspondingly the value of the commodities that they're selling is not able to replace that. So essentially farmers are in financial difficulty in a lot of cases, so this does impact their spending on crop protection. What we actually see in this period, and historically if you go back as well, and quite a lot of a recent analysis that I did showed that when we have these market downturns and the growers have less money to spend and they're looking at alternatives and how they can spend less, we actually tend to see the generic side of the market actually performing better than the big research-based companies as growers start to look at how they can cut costs and reduce their expenditures, and where prices don't really demand a drive in yields particularly. This is when we start to see the generic side of the market outperforming the multinational research-based companies, and we've seen that in the last year as well. Negative for everyone, but much more negative for the big multinational R&D companies. Now, I talked about agrochemical pricing and how that has influenced the market in recent years. What we're looking at here on the left-hand side is the price of ex-factory material from China. And you can see that post-COVID and during COVID for China, China implemented a lot of very strict lockdown conditions during COVID to try and control the pandemic. This led to significant labour shortages, so factories weren't able to operate, shipping lanes weren't able to operate, logistics were badly affected as well. So this led to very tight constraint on supplies coming out of China, and correspondingly this raised the prices of agrochemicals quite significantly as well. But since that peak in sort of end of 2021, we've started to see prices come down rapidly in recent months. You can see the last few months here it's actually started to tail off, so we expect the biggest damage to have already been done. And prices are starting to normalise somewhat, but still at very low levels historically. And what we're seeing is now that China has moved out of lockdown and also they've resolved a lot of issues around their power supply, we're starting to see Chinese factories start to invest again, and the Chinese government as well is backing a lot of this. And we're seeing much more capacity being put in China in recent months, in the last 12 to 18 months. So we don't expect any fast recovery in agrochemical prices in the recent future. And of course, we've also had issues around inventory in recent years as well. So the last 12 to 18 months, and this is stemming back to the pandemic as well, where you had a lot of growers they had issues attaining enough product to last them for the whole season during the supply constraint periods from China. So we had a lot of growers after that doing a lot of pre-buying, so they wanted to ensure they had enough supply to last them the whole season. And this was in most regions of the world. But you had weather effects, you had issues around commodity pricing, you had issues around energy cost and supply based on issues in Ukraine and Russia, for example. So all of this product that had been pre-bought wasn't able to be used, and the channel had to absorb quite a lot of this. So we're seeing very high inventory levels in a lot of regions. And we're really only starting to get through that now. And for example, in North America and Europe, they're starting to move a bit more normally now. But there is still a lot of issues around inventory build-up, particularly in Asia and China, India in particular. So inventory has been a factor in pricing over the last few months as well. And this, obviously, the inventory situation also affects the companies who are trying to supply product into that channel, because if the channel at the retail or distributor or even the farmer level is backed up, then it's very hard to start moving this product into the first step in the supply chain. So that's how we've seen company performance be much more negative than market performance, as they try to supply this market that's already oversaturated with inventory. But we're starting to sort of clear that off now, so we think the worst effects in North America and Europe are over, I would say. And the chart on the right is the US Pesticide Producers Index as well. And this shows, again, a similar situation with product prices spiking, but now starting to come down again. But still quite high by historical standards. And of course, you also have the issue for US growers in that the commodity prices are coming down. Okay, maybe fuel costs and fertilizer costs have also came down, but they haven't came down at the same rate as what the commodity prices. So there is a bit of a tipping point for US growers, particularly for maize now, where effectively it's not profitable for them to grow these crops. So they're going to see a bit more of a focus on soybean in the next year or two, I would say, again, as maize stocks start to increase in the US. And the US is having difficulty moving these maize stocks as well, because we're now seeing Brazil taking up a position as almost a preferred supplier to China for its maize and soybean exports. But maize in particular is a more recent development for Brazil, where they're putting much more emphasis on driving maize production in Brazil in order to export this to China. And really this has a big impact on the availability of US growers to start supplying the Chinese market here as well. Now, looking a bit more towards into future trends and where the market is heading over the next few years, I touched a bit on how the market's shaping up for 2024. And if we look here, we're expecting, this is still based on initial estimates, so this data is fluid and could change as we get more reliable information. But it's looking like market down by around about 6% in value terms in 2024. Some of the negative drivers, so we are still seeing pricing pressure. This is coming from low commodity pricing. And this is having a big negative factor on grower income. So as I said, growers have less money to spend in general, so they're cutting costs in terms of crop inputs. We're seeing the supply normalization from China, lower energy costs as well. And this year, 2024, we have seen very poor weather conditions in much of Northern Europe, so it's been very, very wet. I know this from experience coming from the UK. It's been very wet in recent months. There's a similar situation in a lot of Northern Europe. Big cereal growing markets that have huge winter cereal crops in these countries. But the situation was such that the fields were so wet that farmers were struggling to get out in there to actually plant the cereals. So that's definitely a negative for the market in Europe, where previous year was much more positive based on improved weather. You can see here the UK wheat area down 15%, Germany down to its lowest basically since records began, and French wheat also down. So these are the three sort of main wheat growing regions in northwestern Europe, all down in area in 2024 based mainly on weather. So Europe negative in 2024, but we can see negativity across all regions. So North America also, as I said, US growers really struggling with the cost and cost of trade balance. We'll see that in another slide later, but it's a real struggle for US growers now. We're seeing also Central and South America, particularly in Brazil. This is obviously the biggest market in the region. 2024 is a much more difficult year in Brazil, whereas before Brazil had benefited from a number of years of significant levels of growth, and a lot of that, again, coming from its ability to grow exportable surplus of a number of different crops for export markets, particularly China, but also other Asian markets as well. But we've seen weather conditions coming into play in Brazil in 2024 as being a significant negative. So what I mean for 2024 here is it's really from summer 2023 to summer 2024. So we're covering the 23-24 season in Brazil. And that is when the weather was such that the soybean harvesting was impacted by the weather, so growers couldn't get out and harvest the soybeans in time to plant the second maize crop, which goes in after that soybean crop. So the second maize crop very badly affected. And the second maize crop in Brazil has advanced to become much more important than the first now, in terms of production, in terms of input spend, in terms of yield potential. But growers have missed the optimum planting window for that crop, so it's expected that yields and production are going to be down significantly. And if they've missed the optimum planting window, then a lot of times, they'll be less interested in spending a lot to try and maintain that crop. So issues in Brazil around weather and also agrochemical pricing as well. As I said, we're looking at the 23-24 season, and there is still a period in there where the agrochemical pricing from China was coming down from where it was the year before. For Asia Pacific as well, we're looking at another negative year, very difficult in a lot of countries, and a lot of this is based on weather. But also, obviously, Chinese material in Asia Pacific is a significant component of the market. Globally, China supplies around about 65 to 70% of all agrochemicals that are used. But in Asia Pacific, that percentage is much higher. So the influencing price in China has a much bigger impact on this market than in the other regions. But we're also seeing very unfavourable weather in a lot of Indian markets, Asian markets, in particular India, where the monsoon has been very erratic, and we've started to see cropping seasons being shifted and changing from traditional windows for optimum planting. So a lot of issues in countries badly affected by erratic monsoons, unfavourable rainfall as well. And there's a lot of these Asian markets that are very heavily reliant on rain for irrigation. So any impact on weather has a more significant effect here than maybe other regions where irrigation is supplied through other sources. So yeah, overall 2024 is looking to be quite negative. So as I said, 2022 looks like it was a peak in the recent cycle of the ag industry, and we're now looking at coming into a period of quite severe and expected to be prolonged decline, because we're looking at 2024 negativity, but we don't expect any of these factors to really be fully alleviated by the time we move through into 2025 as well. But of course, there is some positive drivers, so taking some of the negativity out, We're seeing inventories, as I said, start to normalise in a lot of different regions. We're seeing resistance management becoming much more of an issue in a lot of countries where they're having to start looking at the usage of different and often more expensive products to try and control resistant pests. And we're looking at growth in developing markets where, I've marked here Southeast Asia, Africa, some markets in Central and South America, where traditionally the value of crop protection usage in these countries per hectare is significantly lower than some of their counterparts. But we're starting to see this becoming much more rapidly evolving as we move through the years. And we're looking at a lot of African and Southeast Asian countries now, seeing how they can spend more per hectare to drive their yields. And this is partly to supply export markets, but also to ensure domestic food security as well, which became a big issue around the time of the pandemic. And of course, we've had a lot of issues in Europe around Ukraine and Russia, and this has had big impacts on movement of different commodities, including wheat, sunflower, rapeseed. So there's a lot of different commodities grown in Ukraine and Russia that now is really struggling to be supplied into the market. So there's a number of Asian countries that are looking at this situation, saying, okay, maybe we can step in and start to take up some of this. In fact, India were trying to produce an exportable surplus of wheat in order to try and supply some of this demand, but unfortunately, weather and conditions didn't really play into their hands here. So they had some difficulty in achieving this, but it's still an aim for India is to become a much bigger player on the crop export stage. Of course, India is a country where spend per hectare is significantly lower than a lot of the other big Asian markets such as Korea, China, Japan. So there's a lot of potential for India to start growing its usage per hectare and its spend per hectare as they start to look at export markets as an opportunity. Now again, crop commodity prices is a big influencing factor. So what we're looking at here is the recent historical trend. And as you can see, we look in 2022, peak levels, very high commodity pricing situation, which was overall quite beneficial for farmers. But now we're seeing supply chains start to normalise in terms of, okay, the world has essentially absorbed the issues around Ukraine and Russia, but we're also seeing high build-up of stocks of corn in the US, and we're seeing, the commodity pricing situation start to come down for a lot of key crops, and no real recovery. There's a slight, increase if we look at futures prices here, but there's no real sustained recovery back up to the levels that we've seen in 2022 and the beginning of 2023. So this drives a more pessimistic view of the market moving forward when we start looking at these futures prices. Now, I touched a bit on how US farmers are really struggling now based on the commodity pricing situation. And you can see what we're charting here is the soybean and maize prices in the lines, and the operating costs are the bars. And you can see that in recent years, okay, operating costs have came down based on lower fuel prices, lower fertilizer prices from the peaks that we've seen in 2022. However, you can see the commodity pricing has actually fell below what this decline has been. So we're looking at, okay, a reduction in costs, but the reduction in commodity pricing is offsetting this. So essentially a farmer is now much less well off than he was. If you look back in, for example, 2021, it's much more difficult for a US farmer to try and reach that break-even point now. Now, something else that will influence the market moving forward is product regulation. Now, obviously, this is a very heavily regulated industry in terms of product use. In fact, I think it's even more heavily regulated than pharmaceutical industry, which is quite surprising considering we're putting pharmaceuticals in our body. These are only going into a field. But we have seen a lot of regulatory issues in recent years around quite significant products, which is having a deflationary effect on the market. And we're looking at regions such as the EU being very hazard-based in their approach, and it's much more strict than what it was 15, 20 years ago. And we're seeing a lot of big AIs leaving the EU market through regulation. And in some cases, there is no real direct replacement for these products in the EU. So if we look in recent years at the neonicotinoid insecticides, if you start taking thiamethoxam, clothianidin, imidacloprid out of the market, there's no real direct alternatives, for example, in seed treatment control for sugar beet, rapeseed, etc. So they're taking value out of the market, but there isn't the products that can come in and replace it in a lot of cases. For the neonicotinoids, we have seen emergency use exemptions being allowed in some cases, but there's no real long-term solution for removing these products from the market. And if we look at spirotetramat, we're actually looking at another sucking pest insecticide coming off the market as well, and that's having a significant value impact. There is still some alternatives such as flumanicamid, acetamiprid, but overall, the spectrum of sucking pest products allowed to a grower in the EU now is much less than what it was 10, 15 years ago. Another significant product that's came off registration or will be in the next year is flufenicet, and this is a huge product in EU cereal herbicide weed control, and you can see that the value of that to the EU market is around about $300 million a year. There is some newer products coming through that could benefit from this. So in some cases, there is replacements available. Bixlozone hasn't been fully registered yet, but once this is registered, there is potential that could be used in cereals. And also synmethylin, which is, it's an old product that was discovered in the 60s originally, but it's came back through the BASF pipeline and now being introduced into Europe and Australia. And this is quite an effective tool in the control of resistant weeds such as blackgrass. So in some cases there is potential replacements that could step in, but in a lot of cases it's a direct value devolvement, and it does have a big impact on the market. And we're also looking at now PFAS regulations coming in, so we're identifying active ingredients that have PFAS chemicals in them. I've just highlighted some of the ones that have been potentially identified as having issues once this starts to be looked at more closely. And we're looking at quite significant products. This is PFAS list from the US. And we're looking at quite significant products here that, if they decide to say, okay, we don't want any, or we're lowering usage rates of PFAS products, or we don't want any PFAS products because it's affecting the water supply, it's affecting humans as well in some cases. And interesting, there's a lot of quite new, recently introduced products in this list as well. So we're looking at, for example, methane-trifluconazole, haloxifen as well, and fluazidinolazine, which is a nematicide. So there's a lot of relatively new products that, if this list is looked at in greater scrutiny, could potentially be under threat as well. So regulation is not just an issue for older products, it's also for newer products as well. And we're also seeing in the EU candidates for substitution now, including new products such as benzoin diflupyr. So even new products are not immune to issues around regulation. So that is a big issue moving forward. Now, something that I touched on and that can help drive value in the market as we move forward is resistance management. These charts are showing the different classes of herbicides, insecticides, fungicides that can be expected to benefit from a move towards controlling resistant pests. And if we look at herbicides, you can see there's a lot of value expected to come out of the market for the bottom ones. So obviously this is some of the big products such as glyphosate, a lot of resistance development there. Also the ACCase inhibitors, ALS products such as the sulfonylureas. So these are products where they are becoming much less efficacious in the weed control, so they're starting to lose value out of the market as growers have to switch to other products to try and control the same spectrum of weeds. But this is benefiting the other herbicides is a lot of newer introductions, so I talked about synmethylin, bixlozone. We're also looking at new ones like teflupyrilomet coming through as well for rice, which is a big issue around ALS and ACCase resistance. So we're seeing a lot of new herbicides coming through, new mode of actions. For the first time in about 30 years, we're starting to get new mode of action herbicides, so this is a big boost to the market. For insecticides, it's a lot of older products that have been very, very heavily and widely used in a lot of cases, such as pyrethroids, the nicotinamides as well. Resistance is going to become more and more of an issue, so we have to start switching over to newer introductions, and also diamides are a big beneficiary here as well. Obviously, this is chlorantraniliprole, cyantraniliprole, so big products in the market, but ones where resistance development hasn't really been an issue, and we don't expect it to be in the next 5 or so years. Also, obviously, bioinsecticides can play a significant part in resistance development as well, and they are quite highly featured here in terms of growth potential through resistance development. For fungicides, we're looking at a relatively newer class of fungicides, SDHIs, at the top here. Now, I know there's some issues around SDHI resistance, and it initially started in Paraguay, but we are starting to see it come in Brazil as well, around Asian rust. But these are still significant products in controlling a lot of major diseases globally, so there's a lot of potential for these products. For inorganics, these are typically products such as copper, etc. These are products that and also contact products, EBDCs such as mancozeb. These are ones where they're active at multi-site on a particular disease, so it's very difficult for a disease to develop resistance to these. So there's a lot of potential for these products to be used in resistance management. But if we look at the bottom, strobilurins, triazoles, these are products that have been heavily used in the last 10 to 15 years, and ones where the efficacy of these products is not really where it was before. In some cases, you can overcome that by increasing the application rates, but in some cases, effectively, they're not effective now, so they're losing a lot of value out of the market. Now, biologicals is another market where value is coming in. We can see we're tracking biostimulants and biopesticides here, but you can see on the right-hand side, the 5-year average growth rate is quite significant when we compare this to conventional chemistry. So there is a significant amount of growth coming from bio in the future. This is only looking at the next 5 years, but if we go 5, 10, 15, bio is a key growth driver through biostimulants and also biocontrol. Now, active ingredient introductions as well. This is something that had dried up in recent years due to a lot of factors such as cost of development and also then registrations. But we are seeing a lot of new products coming through now, and a lot of that is related to resistance management. And we're also seeing a lot of new discovery companies now coming through as well. These are companies that benefit from much lower costs, but much accelerated timelines in discovery and development compared to the R&D multinationals who traditionally have been involved in the introduction of new active ingredients into the market. And we're looking at companies that, in some cases, they've spun off from academia, so they've came from university backgrounds, who have developed a specific technology that can be used to improve the screening, discovery, and then development phase of different active ingredients. And we've seen companies such as Enco. They started off with a pharma background, but they've now applied that into ag. And we're seeing companies such as Syngenta and New Farm start to tie up with these companies. So it allows them to reduce their costs in active ingredient discovery and development. It gives them access to new mode of action technologies. And for these guys, it allows them to reach a much bigger base through the distribution pipelines of, for example, Syngenta, Corteva working with AgPlenus, and New Farm as well. So it benefits, obviously, both parties here. Now, just to look over the next 5 years and where we forecast the market to be, now, obviously, we've seen in the last year or two quite a lot of difficulty in terms of value development. However, as we've seen, pricing is starting to normalise. We don't expect big improvement, but the worst effects of the decline is essentially over. We've seen inventories start to normalise as well. And obviously, weather is something that is becoming much more erratic as climate change starts to take hold. But it's something that obviously we can't predict, but if we expect more normal weather conditions over the next 5 years, then this is the type of growth levels we're looking at. But we've done it in two methods here because we wanted to show it looking at the price situation in 2021 when prices were much more normal, but also the real situation where if pricing situation was effectively the same as it is now. So if we take out the effect of price inflation in 2022 and look at 2021 prices, we're actually looking at a value decrease over the next 5 years based on all of the issues that I talked about. But if we take away the price inflationary effect and say that pricing situation is really just a one-off issue, then we could expect to see some growth coming through in real terms. And of course, this is coming from resistance development, the new AIs that we've seen coming in, development in markets in Southeast Asia and the Middle East and Africa that I talked about, and also big growth in bio basically across the board as well. So thanks very much for listening. If you have any questions, I'll be free to answer them as I move around. So thank you.